Investing ahead of the curve. Why timing matters in resource markets. In capital markets, timing is rarely discussed openly, yet it is often the single most important factor separating average outcomes from exceptional ones. The difference between investing early and investing late is not simply a matter of entry price. It is a question of positioning capital before broader market recognition occurs. Nowhere is this more evident than within the natural resources sector. As global uncertainty continues to shape economic conditions, from geopolitical tensions to inflationary pressures, investors are increasingly turning toward tangible, asset-backed opportunities. Among these, gold and associated commodities have once again moved into sharp focus. But while many investors wait for confirmation, institutional capital often moves earlier, particularly when three key elements align: defined asset value, clear pathway to production, imminent market catalyst. When these factors converge, a unique window of opportunity can emerge. One of the most significant catalysts within capital markets is the transition from private to public listing. This is the point at which a company moves from limited investor access to broad institutional visibility. Historically, this transition has often been accompanied by a market re-rating, as new capital enters and valuation benchmarks shift to reflect public market comparables. However, by the time a company reaches this stage, much of the early positioning has already taken place. The more strategic approach is to identify opportunities before this transition occurs, when valuation is still grounded in development stage metrics rather than fully priced for institutional demand. In the context of resource projects, this becomes even more compelling when the underlying economics are clearly defined. Projects that demonstrate strong net present value, NPV, scalable resource base, near-term production timelines tend to attract significant attention once listed. Equally important is the structure surrounding the opportunity. Where capital is deployed into assets that are already progressing toward production, rather than purely exploratory ventures, the risk profile shifts meaningfully. Investors are no longer relying solely on discovery, but rather on execution and delivery. This distinction is critical. It is also why sophisticated investors increasingly look for opportunities where capital raised is sufficient to reach production. Management retains meaningful ownership. Cost structures are resilient across market cycles. These factors create the foundation for long-term value creation. For investors willing to take a considered, forward-looking approach, opportunities that sit at the intersection of strong asset value, defined execution, and imminent market visibility remain among the most compelling. Oakmount and Partners, where knowledge and conviction meet opportunity.